People have to realize the enormity of this bubble. There is not a comparable bubble in real estate. This is going to be worse than the crash before. It's going to be way worse than the real estate crash in the Great Depression. This is going to show why the Federal Reserve and central banks shouldn't be manipulating the economy.
The market prediction of the housing bubble is creating a lot of stress among Americans because of the upsurge in both home prices and the rates of interest. It is still vivid in the minds of people, especially those who had their homes plummet down to as low as 50% in some regions of the country in the year 2006. A large number of people who managed to save money and work for years to be able to buy a house with their own money saw all their efforts go up in smoke when the main source of income disappeared in that terrible crash. Some are beginning to see the situation as if they've seen it before. The prices of properties have increased to the highest levels, and many people wonder how long this trend will continue. Not only does this imply a set of prices that does not seem sustainable anymore after nearly 6 years of spectacular growth. The market outlook? Unclear. However, few warnings are as extreme or as loud as those of Harry Dent Jr., an economist who graduated from Harvard Business School and a respected columnist for MSN Money, Yahoo Finance, and the Investor's Business Daily. With this forecast, the question is not only whether a recession is coming, but what is more important, how ready we are for what may ensue. It does not sound logical, but then again, if one looks at what Dent has been saying, one will see that his logic is quite clear. In this recent interview, Dent does not only talk about a massive drop in real estate, but also important points like the aging population and no immigration to countries such as Japan. He does this with the U.S., pointing to immigration as a factor that might mitigate this blow here. Though other developed nations, experiencing declining populations, may suffer even more. This next clip is from a conversation Harry Dent Jr. had with Saks Realty on their YouTube channel. Try to concentrate on the main points that he emphasizes, namely demographics, immigration, and market cycles, as well as reasons for such sensational predictions.
When real estate crashes this time, more than last time, only back to 2012 lows, which doesn't sound that much, but it is 60% now for the average house, 70, 80% for the typical upscale house. We will never see real estate prices at those highs in any of our lifetimes, and probably not even our kids.
Wow.
Stocks in some places will. I don't think our stock market will ever see these highs either. I don't think the Dow will ever see 40,000 in any of our lifetimes again. But real estate, definitely.
Yeah, let's dive into some of the reasons. But first, I want to talk about, and you mentioned Japan. Doesn't Japan have like a 100-year mortgage or something crazy?
Yeah, they go out to 40 to 60, and I think they do have some 100-year mortgage. And that's what people do to stretch it and all. But again, Japan, people would say, well, when house prices go down, no, Japan will never, ever be the same, because unlike the United, we have the option, we have high immigration, and we'd have the option, since we're the most attractive country still in the world, to up it if we really wanted to ask for it, okay? Japan has aging demographics and no immigration. They've never allowed much immigration, and their culture doesn't want immigration. I don't blame them for that. They have a great culture, but they are a dying. Japan is the example to the rest of the developed world of how the entire developed world is plateauing or dying, in only a few countries like Australia, New Zealand, and Norway, Sweden, and Finland. 5 small developed countries of the world have demographics that go higher in the future. All the rest of them are flat to down forever, or as you can see. Yeah. This is a first in the world. Economists don't understand this because they think it's all politics. All they study is politics and politicians and what they're doing and this bill and that. I don't study. You know how much time I spend studying politics? None.
Of course, the U.S. housing market is in the process of experiencing something that has never occurred before. The position is even worsened insofar as the costs are concerned. The reasoning behind this is simple historical analysis. Never in the United States' historical past has the price of homes been this high compared to income. The price of the products is expected to start going back to normal in the long run, depending on historical price movements. Housing prices now are 100% higher, inflation adjusted, than the average over 130 years, as noted by Reventure Consulting. It is much more right-bending that house prices have always moved in tandem with inflation throughout American history. The ratio of home prices to rent never had a national bubble between 1890 and 2000. Rather, it always matched the rate of inflation. In U.S. history, there have only been 2 deviations from this trend. This one, and in 2006. This does not appear logical to many people, and the following arrangement is not sustainable for many individuals. Either inflation needs to rise to the sky, or the home prices need to come down to the ground before the housing market can at least get back to some normalcy. In one way or another, it is still possible to argue that inflation will rise once again, in which case the Federal Reserve would have to raise interest rates again. Sadly, this would only worsen house affordability. Besides declining prices, higher wages would be the only cure for the current housing affordability crisis. If wages are not increased, the current situation could deteriorate and lead to a free fall in housing prices. There is a serious issue, though. Income growth is therefore rising at a very slow rate of decline. This constraint in income growth is a very serious threat to the stability of the housing market. The affordability gap will increase even further and will only increase if the rents and cost of owning a home are higher than the income that has been gained and cannot be negotiated or covered with the same offers. The conclusion is obvious. It can either mean a change in affordability measures, or there is likely to be a degradation to a point where there would be a housing crisis. It is quite easy to discard 100 years of credible data and state that this time it is different. As for the future, some claim that this affordability level will become the new standard for people to pay a higher share of their income for a home. With this in mind, however, it is crucial to admit that this market is mainly fostered by what I call the post-2008 miracle boom. You have not actually gone through a serious recession as far as a large portion of the populace is concerned, particularly those who express their worries on social media platforms. Thus, one might say that this nation has yet to witness a real recession in modern history, save for the spike in unemployment in 2020. While the market has had its dips in specified years that were worse than others, the general public has not endured the financial woes that come from a real recession. All of this is powered by employment. After the personal problems, the most common economic problem is unemployment. And the second is a weak demand for employees in the job market. It is not very difficult for anyone who experienced the 2008 recession to fathom the severity of such times. It is very easy to ignore the impact of the recession by looking at only the unemployment rate, which was 10% in October 2009. This figure does not include such costs as reduced working hours, wage reductions, and other problems that might happen across the country in the event of a severe recession. It impacts all facets of life that in some way can be related to consumption and new inventions, mental health and stress, and many other issues. The numbers cannot express the impact. If we were to face a recession of this magnitude, the property market, which is already overhyped, would be in even more serious jeopardy of a crash, which we have not seen in over 15 years. One can only imagine the extent to which the demand will reduce if things are to go much worse. It is already a struggle for people to buy homes, and this is a market that is already scaling the roof. It is instructive to look at the Japanese experience to get a feel for the worst-case scenario that can be expected in an economic crisis. Japan is an advanced, creative country of more than 125 million people. It is one of the largest economies in the world, even though it is not as large as the economy of the United States. In most histories, Japan had the world's greatest ever asset bubble in 1989. Their version of the S&P 500, the N225, rose all the way up to as high as 39,000. For instance, large caps listed in Japan have been yielding more than 22% annually over the period from 1970 to 1989, while small caps have been yielding nearly 30% annually over the same period. It was a period of complete happiness, and even the real estate industry could not remain unaffected by this enthusiasm. For instance, while the consumer price index in Japan roughly doubled between 1956 and 1986, land prices in the same country rose by 5,000%. Japan, which is much smaller than the US and has 200 million fewer people, has had a real estate market 4 times the size of the US. It was the biggest and the brightest bubble of all. A more than 80% decline led to these in the N225. The index would only reclaim its 1989 high in February 2024, a time frame that any stock trader would have considered a dull market for over 3 decades. Some people believe this their whole career, devoid of any new excitement. And even after adjustment for inflation, the Nikkei remains far from those earlier highs. There is still a long way to go to get back to those peak real index levels. Likewise, the Japanese real estate market must tell a similar story. Still, to this day, it is evident that the average home in Japan has yet to come close to the 47% decline in value that occurred between 1991 and 2009. There is no consideration in the least for inflation in this respect. An example of how severe a collapse may be in a modern economy is the price of a Japanese dwelling today, which is the same as 1987 prices. Of course, Japan does not derive any advantage from being the world's reserve currency or from being a superpower in economic and military terms. Nevertheless, it reveals what can be accomplished in such an environment, and whether this is a positive or negative aspect depends on personal opinions. Managing the affairs of real estate can sometimes be very daunting, especially in times of crises. If this video managed to cast light on the current housing situation, click here to watch the next one. I will see you in the next video.